that puts fear into my world. When somebody says, I'm like, hey, when are you in contract, or when do you need to raise the money by? And they say, oh, no, I've already got all the money raised. I just need the docs. And it's like, that makes me super nervous, because in order to have all the money raised, you must have sent them a spreadsheet. You must have done something, a presentation. A lot of times people already do a webinar prior to, having their attorney review it. So, all right, well, welcome back to the Real Estate Syndicator Live episode 15. Super excited to be back after taking a week off, visiting my goddaughter over in North Carolina. So, but missed you guys, and there was quite a few questions that actually, some of the questions I didn't get to answer last time, so I wanted to answer those this time. So I'm just doing this as an AMA, no rambling, no predetermined topic. Next week we're going to start a series just talking about the 5 things every syndicator must know to stay out of jail. I'll give you a little preview of what's going to be next week. And then Brandon Turner, formerly of Bigger Pockets, is going to be joining us on June 22nd. So a couple of weeks down. We were thinking of having him here this week and get a last minute move. So we'll have him on the 22nd. So hopefully you can join us for that. You can ask him all about what he's up to since leaving Bigger Pockets. But all right, I'm going to start. Easy question to start. I don't know. I'm not even going to ask. So Adrian was asking about where we can find, if there was a vault or anything where all these episodes get housed. We usually release them on the Facebook group, mauriciorauld.com/FB group. Maybe I should type that in the chat notes, since I don't have Bethany with me today. So I'm put it in the chat. But if you want to join us on the Facebook group, /FB group, that should get you there. And then we also post them on the YouTube channel, Mauricio Rauld YouTube channel. Just crossed 1,000 subscribers. So I'm excited about that. But that's Adrian. That's where we house all that stuff. And Michelle, I know you're in here, and I know you had a couple of questions about funds and doing some soft commitments. So if you're on, do you want to just unmute yourself and go ahead and ask?
Yeah, and welcome back.
Well, thanks, Michelle. Good to see you.
Yeah. Okay, so my question was on the fund to funds. I just wanted to understand the process. So what I'm thinking about doing is a 506C. And so is there any issues around asking for soft commitments? Do you have to have the entity and filings in place before you do that? Or is that just when you receive the money?
Yeah, so soft commitments are interesting because, theoretically, I'm less concerned about the actual act of getting soft commitments. We can quote unquote fix that, or we can have a soft commitment letter, and we can have all kinds of disclaimers in that letter saying, hey, this is not binding. You can, whatever. We're just trying to gauge interest and all that stuff. So the actual soft commitment itself isn't what I'm usually concerned about. What I'm concerned about is, what did you have to say to your prospective investors in order to get a soft commitment? Because obviously you had to say something, unless you've got such a ridiculous track record where you just say, hey, I'm Michelle, I'm going to start a fund next week, so if you're interested, give me a soft commitment. I mean, I guess that would be theoretically okay, but obviously you're going to be doing something. You're going to be presenting them something. You're going to be describing the fund. You're going to be communicating. There's going to be some not disclosures, but some statements that you're going to make to your prospective investors to induce them to give you a soft commitment. That's what I'm a lot more concerned about. So I would highly recommend that you get that run by us in your case, but if not, your attorney, just to make sure that you're not falling into the issue of actually making offers. That's the concern whenever you're talking to investors prior to the time that you have your attorney on board, is if you're meeting with them for coffee, or if you're sending out an email, or you're just, you're doing a presentation or something, has an attorney reviewed, make sure you got the proper disclaimers, that you let people know, hey, look, this is a 506B, or in your case, a 506C. You've got to be accredited. You've got to review a PPM. This is not all the information. This is just educational. I'm just trying to get an idea of what kind of information or what kind of deals you want to look for. So the soft commitments is less of an issue. It's just, what are you saying? And I always get nervous when I have clients or prospective clients call me and say, hey, we want to get going, and I already have all the money raised. I mean, that puts fear into my world. When somebody says, I'm like, hey, when are you in contract, or when do you need to raise the money by? And they say, oh, no, I've already got all the money raised. I just need the docs. And it's like, that makes me super nervous, because in order to have all the money raised, you must have sent them a spreadsheet. You must have done something, a presentation. A lot of times people already do a webinar prior to, having their attorney review it. So as long as you're having an attorney review everything, there's a way for you to start sending some preliminary information, like a business. You could have like a maybe something more than just a one sheet. You could have something like, maybe it's a 3 or 4 page, not a full blown business plan, but sort of something more than a one pager, maybe 4 or 5 pages, give somebody a good idea of what you're getting. And then based on that, you can get some soft commitments, pending obviously the full docs. But if your attorney is reviewing those and puts the proper disclaimers and lets them know, hey, this isn't the complete information, and your commitment isn't, binding, it's just, for us to gauge interest, just to see if there's any interest, that's fine. But my fear is just when people just start basically, I think, making, unregistered offers, right? Because the SEC governs not only the sale of securities, but the offer and sale. So it's not just when the time they're actually writing you a check. If you're out there making offers and there's no PPM and there's no exemption and there's none of that stuff, it could be problematic. So I don't know if that answered your question, but that's the issue that I have with the soft commitments.
Okay. Yeah, I need a phone call with you.
Well,
but okay, I know. So then in theory, with a fund of fund, I know that you covered that in detail before. So you are ready to acquire property, you have a fund with all of the correct documents. Speaking of fund to fund, fund A, if that makes sense. And so then you transfer that money over for the acquisition to fund B. What happens to the fund process wise? Does that close out, or is it?
So let's let's make sure we're on the same page. So when you're doing a fund of funds, from your perspective, you're just putting together what we call a blind fund, right? So you're going out to your investor base and you're saying something along the lines of, hey, I'm raising, $5 million to go out and purchase or invest in other people's syndications. And I'm going to look at all these different syndicators out there, and I'm going to look at all the deals they have as they come across my desk. And then I'm going to make the decision as to whether to invest, A, whether we should invest in that particular deal, and B, how much of our fund, right? And so that's what your syndication is looking like. It's a blind fund because the investors are giving you money and they don't know what you're buying. They just have these parameters, right? These fund criteria that, it's going to be real estate, it's going to be multifamily, it's going to be this size, this leverage, maybe a geographical location or whatever parameters you've come up with. But that's what people are investing the money in. So once you have that money either committed, or because that's another thing that sometimes we talk about, commitments or actual money in the bank. But once we get that money in the door, you then start. Once you find that first deal, you're going to write a check and sign all their PPM docs in the fund that you're investing in. And then depending on how we've set up the fund, then you're just going to go find the next one. And if you've got enough money or commitments for the next one, then you're going to pull the trigger on the second one. So it's not like a fund, the sub syndication one close. I mean, it does close because once you've invested and, they have all the money and they've raised the money in their own syndication to close a deal, then you're kind of done with it. I mean, all you're doing is really writing a check and signing. You're going to sign the PPM. Well, you're going to sign the operating agreement for their syndication, but it's not like you're worried about closing fund A, closing fund B, closing fund C. You just have a pool of money in your bank account and you're going to start making, investments based on that money. And maybe at the beginning you want to raise 5 million, but you've only raised 250, right? And maybe the first investment has a 250 minimum. That's fine. And so you can write a check for 250, but obviously you can't write checks for anybody else because you don't have enough money to go buy the next one. You've got to continue raising. So I just want to make sure we're on the same page, because the way you were describing it made me think that you were thinking of each sub syndication almost as separate funds. And remember, with the fund of funds, you have one fund and you just got your parameters. You raise, just think of it the way that most people do. Let's just say you raise $2 million and now you've got $2 million in the bank and you're going to go invest it in 4 different deals. Maybe you're going to put $500,000 in each deal. When they become available and you do your due diligence and you do your vetting of the operators, and maybe you travel and fly down to the property, do your due diligence, and you make the decision to invest, your fund is just like any other passive investor. You're just writing a $500,000 check into that person's syndication. Now, maybe you've negotiated better terms because you're writing a big check, and that's fine. But you have one fund. It's not like you're closing one fund and sort of doing one. You're not doing one raise for each sub fund. It's just you have one big fund and you're going to go invest in 2, 3, 4, 5, 10, however many deals you're going to invest in.
Okay, got it. I'll give you a call.
Yeah, let's do that. Let's get some more specifics there.
Mauricio?
Yeah, go ahead. If there's a follow-up, just unmute.
Yeah, so I see Hunter Thompson. He structures quite a couple of funds, and he usually has like one fund, particular, for example, crypto mining. He had something going, and he structures separate funds. Is that because of the size? Maybe because he's raising like 5 million per fund and structured it separately?
Hunter's a, I thought you said he was on here. Hunter, if I know for a fact, Hunter is an investment advisor, right? So he's got a license. So he has a little bit of a different, he's got some more leeway to do things differently. So for example, one of the things he can do, which I typically wouldn't recommend unless you have a license like Hunter does, is I don't recommend raising money for just one specific sub-syndication. Like I don't recommend saying I'm raising $1 million to go put it into John's deal. I want to be a blind fund where I'm not telling you where I'm going to put the money in, because if I just raise money into my fund for the sole purpose of investing in your fund, I'm just a conduit. I mean, I'm basically acting like a broker dealer. So these are just like smoke and mirrors and stuff. But so the way I like to do it is have it as a blind fund where you invest in multiple deals and you don't tell somebody what specific deal you are. Again, somebody who has a registered investment advisor license could do that because they're licensed. So I don't have that concern as like, you know, do you need to be licensed? Because they are licensed. So that's a little bit of a different situation. Generally speaking, and this is not edged in stone. Other people, other securities attorneys may and probably do disagree with this, where they do allow people to raise money into one fund for the sole purpose of investing in another. My concern is that most of the time, everyone that I've seen, they're just acting as unlicensed brokers because they're not doing anything. They're just raising money and giving it to somebody else. You've got to really do a ton of things. Like I mentioned before, you want to be doing due diligence. You want to be traveling down. You want to meet the operator. You want to be doing due diligence, because if you're just raising money and turning around and writing a check, then you're just being a middleman or middlewoman.
But technically, for example, you mentioned flying down. These are all aspects that the potential investors of the fund wouldn't be doing. So in that particular scenario, if I were to fly to Texas or Tennessee on a regular basis to actually vet the operators, that's legit. I
think that's fine. Yeah, I think in those scenarios, you could pull that off. Because the question you have to answer is, what are you getting paid for? Right? You're going to be taking a 2% asset management fee, maybe an acquisition fee. You're going to be taking a carried interest, right? You have to answer the question, what are you getting paid for? And it obviously can't be, well, I'm just raising money, giving it to somebody else. So what is that? And that's a great one. The one you described is a great look. My passive investors are busy professionals. They don't have time to hop on a plane and spend all this time doing due diligence. That's part of what you're getting paid for, is the due diligence. Negotiating better terms. Everybody else is putting in 50 grand, 100 grand. They're getting this deal, but I'm coming in with $1 million check or a $500,000 check. So I'm in a better bargaining position. So you actually end up getting a better deal for your investors, right? If they invested directly with the operator, they'd get X return. You're coming in and giving them a better return. Maybe you have a seat at the table. Maybe you're on the board of directors now, so you have some influence. There's things that you can do to benefit your investors. But most of the time, what I see is people just like, hey, I just can raise a bunch of money and I don't want to operate. And so I've got another syndicator. So I'm just going to go raise a bunch of money and then give it to the syndicator. And they don't do any of that added value. They don't negotiate better terms. They don't fly down. They don't spend time vetting the sponsor and doing all the things that busy professionals don't have time for. The other thing that the other value, the third one I always forget about is, maybe the investment, it's an amazing investment, but the minimum investment is $250,000. And so most investors can't make that investment, even though it's amazing, but your minimum might be 50,000 or 100,000 to your fund. So that allows them to access the investment through your vehicle, which ordinarily they wouldn't be able to. So that's another way that you're adding value. So the more you can show and prove that you're actually putting the structure together to benefit the investors, and therefore you're getting paid for that benefit, the better you are. But I'm not saying every single one, but most of the ones I've seen that come across my desk is there's no negotiating better terms. There's no, the minimum's not an issue because the minimum's 50K or 100K anyway, and that's what their limits are. And they don't get on a plane and go anywhere. So then what are you getting paid for?
Thank you.
See what you started, Michelle? Let's go through. Mark, you are, because you put it in the chat. You want to ask your first question, Mark? Unmute yourself.
I just really want to know, there's a lot of seasoned people here. I just really want to know, what is the first move? In the sense of starting up. I don't have any deal in the process or any deal in the near future anytime soon. And I just want to do it right the first time. So I was thinking of, and I guess we could, talk offline, but I was thinking of just setting up the management LLC. Wouldn't make sense to put the holding LLC in place or the asset protection trust in place yet. But I was just thinking your thoughts from that and or your
Yeah.
point of view?
Yeah, it's a great question. I mean, and I think I need to put some content on sort of more the practical things of, step one, step two. Look, from that point of view, and I think it's minor, I'm going to give you a bigger answer, I think. But yeah, if you're thinking about what entity should I create, you would start with the management company or the sponsor or the real estate company, because that's the company that's going to ultimately be your website, right? You're going to create a website. So you got to think of the brand, what name, all that kind of stuff is stuff you can do now. You're going to do business cards, what's your title. So coming up with the name of that LLC, creating that management company, or that really what it is, your real estate company in whatever state you reside in, all that stuff is stuff you can do now, to be honest. And then when you start sending out LOIs, you would actually, enter into those LOIs in the name of that management company with an assignment, so that when you actually get the LOI accepted, then you can start creating the property LLCs. But to be honest with you, I mean, that's not, I mean, yes, you can do that. I mean, management companies don't typically, we can do that in 3 or 4 days or a week max. It's not a huge deal. I think, and this is not really a legal thing other than maybe on the just setting up the pre-existing relationships. But I mean, if you're going to do it right, the first step I would do is just start getting out there and starting to meet people, right? Start meeting people, start talking to people on the phone, start, creating, I don't know if you have an investor list already set up, but get that investor list going. And then more importantly, communicate with your list, consistently, add value to them, let them know what you're up to. Because the last thing you want to do is meet all these people and they haven't heard from you for 2 years. And the first time they hear from you is like, oh, I got in a contract and, I'm ready to go. Somebody I remember a couple of years ago was telling me one of the things they like to do, and look, you can do all kinds of things. You can send an email, again, what are the hot markets, or what's going on with interest rates or inflation. Like you can add a ton of value in, why real estate versus the stock market. I'm seeing a lot of those. But one of the ones I actually like, and this is not a legal thing, but you can communicate them, like you can show them deals that you're currently underwriting. You can go in there and say, look, I just underwrote this deal and here's why I didn't put an offer in. It's too expensive. It doesn't have this, or it's that, it's not. And you can actually show them your rationale and your process for your underwriting as to why this deal, even though it looked good at the beginning, you ended up passing. And if you do that a couple of times, then when you actually do get a deal accepted, it's a little bit, it's like, okay, this is not just the first deal. He's been underwriting hundreds of deals or whatever, and this finally found one. So that's a good communication thing. One of our other clients does a really great job, and he goes into these tertiary markets that nobody's heard of before. But before he actually, talks about it and has a deal in that market, he's sending out communications about that market. And hey, did you know that this random city in nowhere has this, or this is the industry? And he talks about the market, so that by the time he comes out with a deal that's in this market, you've actually heard of it. Because otherwise you'd be like, where the hell is this tertiary market? So just communicate. But I think that and we talk about this, when we do the real estate guys is a syndication seminar. That's probably the big thing of building your brand, building your network. In fact, Russ was nice enough to come on. I forgot what episode it was, 6 or 7, Russell Gray. He talks about the sales thing, and he talks about this milk and cereal, which is just, branding and networking. And so branding and, network is getting out there and meeting new people, getting new people on the wheel, getting new people on your list. And then the marketing, the branding is really the marketing. Now that you've got people on the list or on social media or starting a podcast or all those things, just get your name out on those branding. But so I think that's a bigger question than setting up entities, which, quite frankly, to be honest with you, other than the branding part, it would be nice to have a website already set up. You could drive people to the website. Other than that stuff we can set up in a week. So I wouldn't stress too much about that. I'd be more concerned about getting into relationships and starting getting your name out there, so that when you do have a deal, it's not going to be, who's this Mark guy?
No, I got you. And Russell's already a mentor of mine, so I love the
Perfect.
guy. He's
that's right.
phenomenal.
That's right.
But I guess because I'm looking at it from a coming from a non-business background. So like when I look at this, I don't get nervous about it, but I want to do it right. Is it okay? Because I know you talked about this in a prior, whether it was on Facebook or another live. Is it okay once I have an established relationship with someone to hand them a questionnaire? That is asking what? Just like, what are your investment? What have you invested in before? Not offering any type of deal or anything, but just getting some information about them to see if I'm really, if they're aligned with what I'm looking to do. Like if I'm interested in multifamily and they want to go into Bitcoin, 100%. It's not really a match for me, and that's fine.
Yep. And so that's exactly what you want to do when you actually don't have a existing relationship. That's the whole point of establishing a substantive relationship, is to find out whether they're potentially a good fit for you. Because if they want to invest in crypto and you're offering, mobile home parks, that's not a good fit. So how do you find that out? You send them the questionnaire. And if you don't have my questionnaire that's attached to that ebook, are you in the Facebook group?
I am. Yes.
Yeah, so I'll post. Somebody remind me later, but I'll put it's the 5 things every syndicator must know to stay out of jail. And as there's an attachment that has the questionnaire that I just came up with because I couldn't find a good one, and so I just came to. You're welcome to steal it, do whatever, put it on your website. That's the questionnaire. That's exactly what you're saying. Like, what are you interested in? You know, are you accredited? You know, what's your experience? Are you looking for growth? Are you looking for income? Are you looking for tax breaks? You know, what you're trying to figure out, and then get on a phone call with them and say, hey, we're trying to figure out what are your needs. Let me understand your needs. Let me tell you a little bit about our company. These are our values, and this is what we look for. You know, we look for cash flowing properties, so there's less risk, or we're going to go in and find dilapidated 30% occupied. And we're going to turn them around in 2 years. Like, whatever your philosophy is, that's the interaction that the SEC is looking for. They're fostering that relationship so that you can finally get to a point where you can say, hey, you know what? I talked to this person enough and filled out the questionnaire. I think that I believe after talking to this person and doing the stuff that they are sophisticated, that they have the financial means and, you know, the understanding from the business and financial world that they can understand the risks and merits of my particular investment. That's what you're trying to do in establishing the substantive relationship. So absolutely talk to them now. And that's why I was talking about, you know, networking, meaning going out there, obviously getting a hold of people and then send them the questionnaire. You know, hey, would you like to talk? Great. Here's a questionnaire. Do you mind filling it out? Let's talk about it. That'll give me some information. And then here's my little bio, or here's my website, you know, happy to answer any questions that you may have of me. That's the whole purpose of those conversations. So absolutely.
Okay, because I didn't think that was breaking any rules yet, because I'm not offering anything other than just trying to seek knowledge.
Yeah, in fact, you're doing it properly. Like, as you mentioned at the beginning, you are trying to establish substantive, assuming you're going to do a 506B, because if 506E, you don't need to do that. But assuming you're planning on doing 506B, the more of these questionnaires and conversations you get into, and the more of them you do, the more solid your argument or your facts are that you actually do have substantive relationship with your people when it comes that time down the road to send them a one sheet or a business plan once you found a deal.
Okay, thank you.
Yeah, of course. All right, Mike, thanks. I'm going to ask, I got Michelle here. Let me ask one more here real quick. There's a lot of questions. I don't know if Juan Hui Lee is here. Juan, are you on here? I know this is from like 2 weeks ago. We didn't get to them because we ran out of time. So he wanted to talk about the accredited investor for international investors. And so let me just read this because I think it may affect. Are there any different requirements for accredited investors who are not U.S. citizens? However, they are either A, U.S. permanent residents who are U.S. permanent residents who reside in the U.S., or U.S. residents who currently do not reside in the U.S., and 3, non-U.S. residents residing overseas. So when it comes to accredited investor stuff, if they're a U.S. resident, meaning a U.S. resident means you're not a citizen, but you got either, you know, and you don't have a green card, you're actually a U.S. resident. It doesn't matter whether you're living overseas or living here in the United States, you are going to be a U.S. resident. And so for accredited investor purposes, it's going to be the same. In fact, it's going to be the same no matter who you're talking to. So if you're going to do a raise and you have accredited investors, or you can only accept accredited investors and you're going overseas, they have to do the same requirements. They have to have $1 million in net worth, excluding their primary residence, or they have to earn $200,000 a year. The challenge is going to be proof. Like, how do you, here it's easy, you know, you got tax returns, but how do you actually prove? I mean, I know some countries, it becomes harder and harder to prove that limitation, but it's just going to be, you know, you're going to have to find other ways to prove, if you're trying to take reasonable steps to verify, to prove that they're accredited. But it's going to be the exact same rules. If they're non-U.S. residents living abroad, then you have the option of bringing them in under Reg S. We talked a little bit about that in one of our lives, but Reg S is a specific exemption, separate from Reg D, separate from Reg A. Reg S covers you for foreign investors. The U.S. doesn't care about investors that are not U.S. citizens and not U.S. residents. So if you have somebody, in Germany who wants to invest in your deal, then and let's say you can only accept accredited investors in your 506C, they're non-accredited, bring them in under Reg S. They don't have to be accredited under Reg S. So always remember that when you're talking to non-US persons that don't live in the United States, you have that Reg S option, which allows you to kind of bring them in. And I don't say circumvent because it seems like you're nefarious, but you're not bringing them in under Reg D or 506B or 506C, so you don't have to worry about that. But if you are worried about that, then it's going to be income or net worth, and you're just going to use the official conversion rate for the dollars on the time of sale of that security. So I don't know if that was a little bit too convoluted or not, but wanted to get that answered to Wei, since we ran out of time last time. Taylor Towler. You want to hop in here and ask your question? Or I can read it. Just unmute yourself. There you go. Hey, Taylor.
Hey man, yeah, I'll pop in for a second. I'm driving, so
yeah, no worries.
Sorry, there's a little bit of background
I can read it if you want.
But yeah, my question is, if somebody,
I think his connection's a bit low. I'm going to read the question, Taylor, because I think we're losing you over there. So he says, if someone is a C or director level, so a C level executive or a director member of the company, can they loan money to the company without running afoul of securities laws? 100%. The only thing I would caution is that's something I would disclose. Because that may have it could theoretically have a factor on an investor, because if you have a deal on it, and usually this system comes in two scenarios. Number one, you're short on the raise. And so what happens if you need an extra 100 grand, you're closing tomorrow, you don't have the money and you're short 100 grand, can you loan the money to the company? Yes, but there's usually a disclosure to that. And we have one in our PPMs that say, if for whatever reason we're short and, we can either come in as a placeholder until we continue to raise post-close, or we can do a loan at X%, interest. As long as that's disclosed on the front end, you could do that. And then the other reason that you would loan money to is if you need a cash call. So if you need a cash call and you need, 500 grand and you do the cash call and you only get 300 grand and you're 200 grand short, then again, there's typically language in the PPM that then allows the manager to loan money to the company, and there's a predetermined interest rate. At that point, if it's a cash call and you're short, it's usually a more hefty interest rate than if you were short on a raise. It's usually around 10%. But the nice thing about securities laws, or not securities laws, the nice thing about doing syndications is that you can be really as creative as you want to be. The name of the game, as you guys know, is disclosure. So you just want to make sure that that's in there, even if you're not planning on doing it like we do. It's just always a nice thing to have in there that says, in the event that we are short on the raise, we're allowed to do that. Or in the event there's a cash call and there's not enough money from the cash call, that we have the right to loan money at some predetermined interest rate. And as long as they sign off on that, you're going to be fine. So the answer is you can absolutely do that without any issues. Now, if you're, that's going to be you lending money. So yeah, so those are the two scenarios that it would come up, and you can absolutely do that. All right, let's keep going down here. Pratima Sharma. I'll read it if you want to unmute yourself, Pratima. I'll just go with here. Question is, have there been any new? Yes. Oh, go ahead, Pratima. There he is. You got it? You want me to read it?
Yes, no, that's right. Just question is, have there been any new investor rule change for the accredited investor in a 506B? Do we still need to have an existing relationship prior to the PSA is signed?
Yeah, so there haven't been any new rules on the accredited investors since December of 2020. We talked a little bit about it last time, but happy to talk about it again. The last expansion happened in December 2020, where they allowed a couple of extra people to sneak in as accredited investors, meaning somebody who had a specific investment advisory license, so a Series 65, Series 82, Series 7. They now are automatically, as long as they're in good standing in their state, they're automatically investment advisors. There's knowledgeable employee that if you're doing a fund, like Michelle was talking about earlier, if you have somebody in that fund who's like, basically at sort of an executive level making decisions in the fund, then they're going to be called a knowledgeable employee. There's some requirements there, but that's one way to get it. And the expansion really was meant to add more and more certification programs along the way, where the SEC was going to designate some people that allow them to basically issue an exam, and you can take an exam and you can pass the exam and you can be an accredited investor. That hasn't happened yet. It's been 18 months and we're still waiting. And so that's supposed to be rolled out. Who knows when, but it's been 18 months and we're still waiting. There's some rumors that there's going to be some updates to that coming here shortly. Again, there was supposed to be a proposed rule coming out in April, and here we are in June. I just checked it actually this morning, and the SEC website, there's been no updates there, but I'll rest assured that the minute that comes out, I'll probably do a live. That's not even on Wednesdays, unless it comes out on a Tuesday or something. I'll literally do a live the next day. I need a day to kind of read the proposed rule, but we'll do a live right away. And let's talk about the pre-existing relationship. You having a pre-existing relationship, your question has a two-parter there. Let me repeat the question because it's interesting, and I want to tear it apart a little bit. I think this will be helpful. It says, do we still need to have an existing relationship prior to the PSA being signed? Having a pre-existing substantive relationship with your investor is one way, and by far the most popular way, to show that you did not generally solicit or advertise your investor, right? That's the way that 95, 96%, 99% of people show that you did not advertise. It's not the sole way. There are other ways to do it, the most common being a referral, right? So if I know somebody who's looking to put in 100 grand somewhere, and I'm like, hey, I know, Pratima here's got a deal. Let me make an introduction, because I know, without getting involved in the merits and whether it's a good deal or not, let me just connect you guys and make that introduction. You will not have a pre-existing relationship with my referral, but you don't have to, because you obviously did not generally solicit or advertise to them. However, that pre-existing substantive relationship, I shouldn't say however, because I'm back to square one, is not before the PSA is signed. It's before you have an actual offering. And that is a little vague, I get it, but it certainly could happen way before the PSA signed. It's just basically, when is it the first time that you spoke to somebody about your offering? So you could, certainly if you send an email out about, hey, I'm in an LOI, or I'm looking for it, or if you're doing a fund where you don't even have a specific deal, it is possible to start an offering prior to having a PSA signed. Theoretically, you could have an offering that doesn't start until after. You could theoretically get into a PSA thinking you're going to buy it on your own or do a joint venture. And then once you get going in the due diligence, you realize, you know what, I'm going to change my mind. I'm going to do an offering and I'm going to syndicate it. Your syndication didn't start until that decision was made. And so it has to predate the offering, not necessarily the PSA, not when you hired the attorney, not when your due diligence was done. No, it's when the offering started. And it's going to be fact and circumstance. Somebody had to give me a specific example of what they're doing. And I could probably tell you pretty definitively whether the offering started or not. But in general terms, it's just understanding yeah.
So example is that if we have an LOI sign, and I have a member who I have a relationship for so many years, and he or she bring a friend, is that okay? Yeah, that person is sophisticated. Can we bring them in a deal?
Yes. No problem. As long as you document it, right? So what you want to have is an email from your friend or your contact saying, hey, please meet Johnny or Karen or whoever. I want to make an introduction. I thought you guys should meet. I'll let you take it from here. The usual emails. And that way you have something in your file that shows that they reached out to you and you didn't reach out to them.
Right. Yeah. So that we follow that. We just don't reach out to them.
Yeah.
It's just kind of hairy because we are in a deal right now, and we just, we have done quite a few deals, but every time we do the deal, we always have the antenna starting to come up. Are we doing the right thing? Are we doing the right thing? We don't want to get slapped on. We don't want our agent standing in front of our door. So we are always very careful.
Yeah.
Anything we are doing. So
yeah, so that's a good point. So, but the way your language even says, so you have a deal now. So you've almost acknowledged that you have a deal. And so at this point, if you don't have a pre-existing relationship, if you don't have a substantive relationship with the person from that point forward, they're not going to be eligible unless it comes as a referral from a third party and you can document that.
Right.
So
now, the second question on the 1031, very quickly. Do we have to bring the total amount of 1031 to the new deal, or can the part of the total amount be transferred to a 1031 deal? Example, if I have a $10 million on a deal that we are selling and we're rolling over to a new one, we have to bring $10 million, but out of 10 million, 2 or 3 people say, well, we don't want to get in. So we have a $7 million. Can the $1 million be refilled with someone else and still be a 1031?
Yeah. So I know Justin, I think I saw Justin together. I'm not a 1031 expert, but I do know basics of 1031. And you don't have to, but in order to avoid the tax, your new investment has to be the same or higher amount than what from the relinquishing amount. If you don't put that amount, you can still put less, but that difference you're going to pay taxes on. I think it's called a boot. You're going to pay tax. So if you have a $10 million gain and you decide only to put $7 million, you're going to pay the LLC is going to pay taxes on the $3 million deficit. So you can do it. You just won't be able to defer, obviously you're not going to defer the $3 million that you didn't put in. I don't know if you have anything to add there, Justin, if that's really in your wheelhouse, but I just threw that out there. But that's how that would work.
Thank you. Thank you,
yeah.
Mauricio.
Michael Seeley, you on? I know you submitted that question ahead of time. If not, I'll read it because it's a good one. All right, for Michael, who's probably gonna watch this later. Michael says, I'm getting more projects where I have those seeking to lend money on the upfront side for soft money use or to contribute to the project until stabilized. These funds typically include a coupon for equity out of the GP side. Could you address how we have to address funds like this and how the SEC differentiates bridge and mezzanine lending? So from a lending, the first thing I'll say that loans are securities just like equity. So I've had this conversation a lot the last couple of weeks where just because you want to structure it as a loan doesn't change the fact that you still have, you're issuing securities, you're still going to need a PPM, you're still going to need a subscription agreement, you're going to need everything that you usually would do. The only difference is the structure, whereas opposed to them signing an operating agreement because they're going to be members of the LLC, they're going to sign a promissory note or a loan agreement. But that's just a structural issue. As you guys know, as I say it all the time, the structure itself doesn't matter whether it's a security or not. And so the first question on this one you have to figure out is, even though the money's coming out of the GP side, is the loan coming from the syndication LLC, right? Or is the loan literally coming from the GP entity, right? Because that's going to dictate, how we address this. If it's coming from the syndication LLC, where you say, hey, we're raising $1 million and we're giving you 80% of the deal, and in addition to that, we're going to raise another 500 grand, but it's going to come from this side. That's going to be all encompassed in the syndication documents for the main syndication. But if it's off to the side and it's just the GP entity for some reason is getting money that way, we'd have to look at, that's going to be a separate offering. Think of it as a separate offering. So if you're doing a separate thing with just the GP, the question is going to be, is that a security? Do we need a full-blown PPM? How many are you doing? Is this a fractionalized note? Are they accredited? It's going to be a separate analysis, because at that point, you're really doing two separate syndications. And I have had that issue, especially in the mobile home park world, where people raise money to buy the park, and then they may need to buy additional homes for the parks. And so they have a separate loan. Although, again, the loan's usually done with the syndication LLC. Now, the GPs may guarantee it. They may, the interest may be coming out of, their side. But usually it's done with the syndication LLC. And if that's the case, it's probably the easiest way, because you just wrap it all in to the same docs and you just disclose that you're raising X amount of money from equity and your X amount of money for debt. And whether it's a mezzanine or bridge and all that stuff, it's differentiated only in the risk disclosures, right? So just all of that is disclosed in the PPM. Who's getting paid first? Who's getting paid second? What are the interest rates? And then, the risks involved with the mezzanine and bridge, which are significant, because if you can't refinance 2 or 3 years from now because the market's flattened or turned or interest rates are at 8% or 12% or whatever, that's a risk that just needs to be disclosed. So hopefully that answers to you, Michael, but thanks for writing that in. It's been a while since I've seen you, so good to hear from you. All right, let's keep going down here. Where was I here? Fatima. So Frank
Yes.
Wolf.
Hey, Mauricio, thanks
Hey, how
for
you
your
doing?
time.
Yeah, of course.
Appreciate it.
Yeah.
So my question is, I've been asked by a number of real estate syndicators to help them raise capital for their projects. And I was wondering how you would structure the compensation for my efforts. And you may have spoken on it a little earlier, but if there's some specific things that you'd recommend that I need to do, I would appreciate that.
I would get yourself a broker dealer's license or an investment advisory license. If all you're doing is raising capital, then you're not allowed to do that without a license, right? Just like you can't practice medicine without a medical license or practice law without a law license. You can't raise capital for others without having a broker's license. And even a little bit of a misconception, even an investment advisor can't receive direct compensation. Typically, an investment advisor will hang their license under a broker dealer, and the compensation will go to the broker dealer, and then the investment advisor will split that fee with the broker dealer. The only way you can do that is by not solely, or not primarily raise capital for the syndication group. You have to be a legitimate co-sponsor, meaning number one, you have to be doing substantial work, substantial duties, helping with underwriting and due diligence and asset management or whatever it is that you're going to do. And then your primary role needs to be whatever those substantial duties are. And the hallmark of broker dealer stuff is going to be a commission or a percentage of the deal. So if you're trying to structure something, that's the last thing you want to do is have a commission base or have it completely tied at all to the amount of money you're raising. Because if this goes south and you're sitting across the table from an auditor, they're going to ask you, they're going to say, hey, look, they're not going to ask you. Let's say I'm the syndicator, and they're going to ask me, and they're going to say, hey, I see that Frank over here, are you thinking of getting, well, one way that people structure it is giving a piece of the GP. So they're going to say, hey, Frank over here, I see owns 6% of the GP, but I didn't see any that he actually, contributed any capital. So what did Frank do to earn that 6%? And your answer cannot be, he helped me raise capital, right? Your answer is going to have to be, well, he did A, B, C, D, E, F, and you're going to have to show that you actually did it. Not, it can't just be in some agreement that you have that you're going to do. You actually have to show. If you're going to say, hey, he helped me with due diligence, you're going to have to show plane tickets and hotels, wherever you flew down to do the due diligence. And if you're asset managing, you just have to prove it. The burden's going to be you on proving it. But you cannot get compensated to raise capital. It can be incidental, because as a syndicator, like if I'm just doing a deal all by myself, I'm doing 1,000 things, not 1,000, but I'm doing, 10, 12, 15 things. One of those is raising capital. But I'm doing the underwriting, the due diligence, the market analysis, the closing. I'm talking to lawyers. I'm talking to CPAs. I'm doing the asset management. I'm doing the investor relations. I'm blah, 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 right? I'm overseeing the property manager. I'm executing my plan, all of that stuff. And so as long as your capital raising activities it's primary. So to me, it's as long as your capital raising activities are 50% or less, so that your primary role is doing something else, those are the keys. Now, the other thing you can do to kind of type out what Michelle was talking about in the first question is, if you're really good at raising capital and you don't want to try and, because that's, you're trying to fit that round ball in the square peg or whatever that saying is, you're really good at raising capital. You have a knack for it. You just have a lot of relationship. People trust you, and you're really good at, all that stuff. Then one of the ways you can structure it is by creating your own fund. And so if you create your own fund and you're able to raise $2, $3, $4, $10 million into that fund, do all the work, right, for the benefit of your investors, doing the due diligence, going down and meeting the team and vetting the team and doing the due diligence and doing all these things, negotiating better terms. And then you can write a check to whoever's asking you to go raise money for them. Now you're just writing a $500,000 check or $1 million check on behalf of your investors. But again, I wouldn't do it one-to-one. I wouldn't say I'm going to go raise, these guys need $1 million from me. Let me go raise $1 million just for this deal. I would go raise $4 million and put it into 6 deals. And this is just one of them.
Great.
Yeah.
Thank you.
Great question, Frank.
Appreciate it.
Yeah, of course. My pleasure. Nathan, LinkedIn on there. Feel free to connect with Nathan, everyone. William Carpenter. You want to unmute yourself, William?
Yeah, how are you doing?
Good, man. How you doing?
I feel like you kind of answered my question with the last one.
Okay.
I think my struggle is, it's sometimes you get relationships later in a deal, and I guess if it's somebody, they can do more, but you're kind of at a place where the only thing that you have left is to raise capital. I mean, what do you do with that person that you want to be involved or do business with them because you really like them or you have some kind of relationship with them? I mean, I guess what can you do?
I mean, this happens a lot for first-time syndicating. In fact, it's one of the main ways that when people ask, how, if you're just starting out, how do you get involved? I do have a lot of clients who are established syndicators who have first-time syndicators that own maybe 2% of the deal, 3% of the deal, and they're there for the experience primarily. And they're just, I don't want to say they're I don't want to say they're bringing people's coffee and carrying bags, but they really are learning. So they're a little bit of gopher, and they're just doing whatever. They're assisting the main syndicator, and in exchange for that, they're giving a piece of the GP. But it's really it's almost like an internship, right? They're looking for the experience. So typically, a good operator will actually try and help them out and have them actually do stuff. Just don't do it's not the raising capital. Maybe they're helping you. Who knows? Maybe they're traveling down with you when you're doing visits on site on the property, or on the asset management calls. They're on there and taking notes and participating, or maybe it's investor relations and helping whoever your investor relations person is and helping them get reports out. And as long as that percentage is commensurate to the amount of work they're doing, and also how much money they end up bringing in, you're going to be fine. I always give the example is if they're doing a little bit of work here, it's not a ton, and you're giving them 2% of the deal, and they bring in, just incidentally, they're going to bring 1 or 2 investors in, and suddenly they bring in $100,000 or $150,000, that's fine. But if the same set of circumstances and they're getting, they're not doing too much work, but they're getting 12% of the deal and they're bringing in $600,000, now it starts to look like that $600,000 is in exchange for that, that additional 8 or 10%. but just don't make it part of of raising capital. That has to be incidental, not the primary role that they're doing.
Okay, thank you. That helps.
Of course. Taylor, oh, somebody else. Let's talk Bitcoin. Dan says, build your list, network like crazy. I guess this is the answer to the first question of what you want to do. Michelle says, get in the room with the people who are doing it. I like that. William, it's all about relationships. Michelle, attend the Secrets of Successful Syndication with the Real Estate Guys in September. I'll be there if you guys want to go. It's a great event that Russ does. Great idea. Great comments, guys. I really appreciate it. And if you guys are not part of this amazing back and forth happens on the Facebook group as well. So if you've got questions on the Facebook group, you can post it there, and everybody comes out of the woodwork to answer. So, Jan, I joined a little bit late. What is the Facebook group called? It's the Real Estate Syndicator Community, and I put the link in there. It's mauriciorauld.com/FB for Facebook, FB FB group. Oh, there it is. Thanks, Johans. William Carpenter, is that US dollars? So do I need to do some kind of dollar conversion? Yeah. So the question from William, I guess you're still on here, but we were talking about the foreign, trying to, when you need to take reasonable steps to verify that your overseas investor is accredited, how do you do that? Because obviously they're earning money, or they have net worth, maybe in multiple countries. Maybe they got property. If they're living in Europe, they may have properties around the world. So yes, there's a conversion. So you use the official conversion rate at the point of sale. So whenever that document, that subscription agreement gets countersigned, figure out how many francs or yen or whatever, and just use the official conversion rate to figure out if they're at that $1 million or that $200,000 limit.
And I guess just to go with that, I guess
Yeah.
part of why I'm asking is, I've done a lot of tax return work, and converting, there's usually like an annual dollar amount. And so that's kind of why I didn't know if there was some other deal or if it was just the day that the transaction's happening. So
I would do. Yeah. I mean, hopefully it shouldn't be an issue. I mean, it may be, I'm not discounting it. I mean, somebody may have literally $1,053,000 in net worth. And so the conversion may happen, but hopefully you're not close to that. But I would just use the official US rate. I know there is one. I don't know exactly. I wouldn't use, Yahoo Finance, but there's somewhere that you find the official rate, but I would use the date that the sale happened, which for me would mean the date that they signed the subscription agreement and you countersigned the subscription agreement. So you have a binding contract. That's the date that I would use. And then I would just use the conversion date of that date. Dan found a Reg S webpage if you want to take a look. Dan, you want to post? I don't know if it's the same one I have, but if you want to post that on the group, that'd be cool. Mark, please share the link to the questionnaire. All right, I don't usually like to, let me just, I'm going to do that in the Facebook group.
You don't have to do it now.
Yeah, I'll do it in the Facebook.
later.
Yeah, I'll do it in the Facebook group. It's actually just jail@premierlawgroup.net. It's just an auto response. So if you just email jail@premierlawgroup.net, that'll auto respond to you. But if not, I'll just attach the ebook to the in Facebook. Justin says I was correct on the 1031, so that's great. Thanks, Justin. Drew will be at the Real Estate Guys event in September. Hopefully other people. Who else is going? Anybody else? Give me a thumbs up if you guys are going. Cool. Anyone going to the FO Real Estate Investors Conference on Monday, June 6th in Newport Beach? Hey, Newport Beach is down the street. I don't know if anybody's going there. Well, guys, I don't see. Oh, let me see. I do have one last question, which I thought was interesting. It's a quick answer. So the question was, and this is also from Juan, does owning a real estate property in the US make it easier to qualify or maintain status as an accredited investor? Does owning a real estate property in the US make it easier to qualify or maintain status as an accredited investor? Not really. It might be easier to measure if you've got a foreign investor and you're trying to figure out their assets. Obviously a property valuation is relatively easy to get. You don't have to get an appraisal. You can get a broker price opinion on the property. So it's maybe easier to measure, but it doesn't change the fact of whether you're accredited or the fact that the property's in the US or not doesn't really make a difference. So, all right. If anybody has Dan, short version is outside. Dan says on Reg S, the short version is outside the US, do whatever you want, but don't ask, don't tell. All right, guys. Any other questions? I'll open it up. If not, next week we're going to do the 5 things every syndicator must know to stay out of jail, which is actually the ebook. So I'm just going to go through those to kind of get the thing going. And then June 22nd, Brandon Turner, Bigger Pockets will be here as well. Jen, you have a question? Let's do. Jen, you want to unmute or do you want me to read it? I will read it. Jen asks, I am new to syndication and plan on starting. Do I need to have an entity set up or do I first need to get the deal? You can, if you're going to set up any entity, it would be your management company or you can call it whatever you want, but whoever the sponsor is going to be, right? Or the manager, the GP officially, because that's really your real estate. You're starting a business. If you're going to take this seriously, you're in the syndication business. It's a business. You're going to need a real estate company. And that's the one that you would set up. That would be set up in the state wherever you reside, because that's where you're doing business. And that's the LLC. The name of that company is going to be your brand, right? So you're going to have a website, business cards, all of that stuff. That's the one you can set up. You could also, if you wanted to start your asset protection stuff, you could start creating your holding companies, right? Because the holding company not only will own your interest in the eventual syndication, but it can own interest, currently if you have other assets, you can use that. So those 2 entities you can create now. The one that there's no reason to start is going to be the syndication LLC itself, because number one, that's going to be created typically in the state where the property you get into contract with. So unless you know for sure it's going to be in a particular state, really no reason to set it up. Really, there's no reason to set it up, period, until you actually know you're going to do it. But if you wanted to do that, and the other issue is that depending on the lender that you choose, the lender may want you to set it up in Delaware anyway. So there's no reason to do a jump start on your syndication LLC. But a lot of people, in fact, I wrote maybe I'll put this up on the Facebook group many years ago, which I want to update. It's still pretty good. I called it the 8 critical steps to practicing safe syndication. And step 1, or no, I think step 2 or something, was creating your real estate company. And I had a little diagram in there. I'll post that as well in the Facebook group, but that was one of the steps. But don't bother about setting up the syndication LLC. And honestly, all of these, you can set these up in 3 or 4 days. It's not like a huge deal. So I wouldn't be too stressed about that stuff. Christopher, why not a Delaware series LLC? Man, you're getting in there. Well, you wouldn't create one for your real estate company. The only reason I could see you creating, the only way I'm not a big fan of series LLCs. In fact, I did a video on Ken McElroy's channel. The last video I did there was on series LLCs and why I didn't like them. But the only reason it would make any sense at all to do a series LLC is if you had a blind fund. So if you were going to do a fund and you're going to have multiple properties underneath the fund, and instead of having to create a separate LLC for your 4, 5, 6, 10, however many properties, a Delaware or a Wyoming. In fact, people who now are doing series LLCs tend to prefer Wyoming over Delaware, but that's when you would do a Delaware or a Wyoming series LLC in a fund. But if you're just doing a one property syndication, or you're doing your real estate company, or maybe your holding company could be a Wyoming. But again, I'm just not a big fan of it. Go check out the Ken McElroy video. That was a good one. I think it was pretty popular. It's on his channel. And then William was a good point. Not all states accept a series, which is one of the reasons I don't like them. But if you're doing a fund, for example, a blind fund, we set those up. You can set those up anywhere, right? So we can set those up in Wyoming and Delaware. But all right. Thank you again for sticking around. Next week, as I said, 5 things every syndicator must know to stay out of jail. And I will put that ebook and actually both articles on the Facebook group. So if you're not a part of it, we'd love to see you over there. And until then, we will see you next week. Thanks, everyone.